What is the effect of asset price increases and soaring public debt on your industry or the economy?
Well, for us, we would use that as an input to our broader investment decisions and how we think about our portfolios. The observation that asset prices are high and that public debt is soaring tells us that A, we need to be thinking hard about exiting investments and selling investments. B, we need to be taking advantage of the current situation to lock in capital structures, lock in low interest rates, lock in covenant-free debt so that we can survive any potential downturn over the next 5 years. And C, we still have to figure out a way to invest in that environment. And so we have to use that as an input and that knowledge that asset prices are high to figure out places to invest, safety, multiple levers of driving value change, more idiosyncratic risk, more operational risk that we can effectively manage within our control and create structures that are long-term and can withstand that. So that's how we think about it.
Thank you. I'll focus more on the increasing public debt burden because that's more akin to what we do. Again, we insure banks against non-payment on loans to sovereign and sub-sovereign entities in emerging markets. And we're very concerned by the rising levels of public debt, the rising levels of debt to GDP ratio, and the potentially unsustainable debt trajectory of a number of key economies in the emerging world. Most of this is driven by overdependence on commodities. If you look at the situation in Angola, which is one of our big exposures, most of that borrowing took place in an oil price environment between $80 and $100 a barrel. When oil fell to 40, they were in deep trouble. Now they're just about at a break-even level. So the overdependence on commodities is a very risky strategy. If you look currently at Zambia, another country which we're looking at closely, it's about copper. 60% of the country's foreign exchange reserves are based on exports of copper. Copper prices are at an all-time low. That's another example of it. When countries over-borrow and get into trouble, they restructure. This turns into losses both in the insurance market and the CDS market. It takes years to recover. It's bad for the population. It's bad for other developmental indices. So it's something which we're looking at carefully and are following and concerned about. Thank you.
So high level of debt, soaring debt, has been a problem for the Italian economy. We had a sovereign debt crisis. We were at the center of the sovereign debt crisis together with a few other countries in the euro area. That meant that the country went into a recession, and the effect of this recession is still felt now. For our business, we consult banks. Banks were in trouble because during the recession they don't do very well. Also, they had invested in government bonds, so this was a direct link between the risk in government bonds and the risk on banking books. For us, it meant that we have to do a better job and try and consult them to recover their profitability and try and do their jobs better.
Okay, so in principle, I would say high asset prices are a good thing. They provide collateral, they enable borrowing, they enable investment. The problem, of course, is they can come down. And when they come down, bad things happen and the market does not always prepare adequately for them. So they do pose a risk in this regard, and it's closely related also to the soaring level of public debt. The last two US recessions have been accompanied by collapse in asset prices, and much of the high level of debt that we see nowadays in advanced economies follows directly from the last collapse. High public debt, I think, is never good news. As long as interest rates remain low, they can be sustained, but when interest rates rise, we'll see whether it poses a problem.